Bankers are vying for ranks. We take a look back at the week. And yes, there's more to say about JP Morgan. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. It is Friday, and I'm Matt Koppenheffer. Right here next to me is David, ready for Pizza Day.
Very ready.
Hansen. David, I know you are ready for Pizza Day. We still have to deliver the show. I'm sorry, so we'll get through it. But first, Jimmy Kimmel in a Twitter rap battle with Kanye West. If you were to have a rap battle with anyone, who would it be?
I don't have a lot of street cred, so I'd probably be in a battle with like Dr. Seuss. That's probably who I'm rap battling right there, not Kanye West.
You don't have your set high enough. I would go for Dr. Dre. If I'm going to be in a rap battle with anyone, why not the king of rap? Not to mention, Dr. Dre is kind of old at this point, also very rich. So if he decides to get angry and hits me or something,
yeah, but I've got like the king of Child's Book, so win-win.
All right. Speaking of Dr. Dre and being very rich, our first story here is from DealBook.
Of course.
And it is Beats secures investment from Carlyle and buys out HTC. This is a $500 million investment that Carlyle has made in Dr. Dre's company that makes those Beats by Dre headphones. This values the company at over $1 billion, and the article on DealBook was talking about the company having $1.2 billion in expected revenue for the year. What do you think about this investment for Carlyle? Do you think this is a good investment?
I don't see why not. It seems to be a pretty nice market to be in. I think the article said they have Beats has over 60% of this premium headphones market. So that's pretty impressive.
That caught my eye too. That is a huge market share.
And I think it just goes to highlight how unique the type of investments these big private equity shops can make. The Carlyles, the Blackstones, the KKR. These are type of deals that not just every investment firm can go out and make. And if you're a shareholder in these, you're kind of getting a slice of that management of the brain power of these organizations, so it can be kind of attractive.
Yeah, and we don't know exactly what the valuation, what the multiple is that they're paying here, but given that they're talking about the valuation being just over $1 billion and $1.2 billion in revenue, there's some risk here that this is a little bit of a fad. But again, like you're saying, these guys like Carlyle, like the KKRs of the world, they can get in on these private companies before they hit the public markets and potentially make a good chunk of change.
Yep. Next headline was over at Bloomberg, I believe. Goldman Sachs, Morgan Stanley estimates lowered by hints. So the third quarter coming up, and apparently not going to look too great for Morgan Stanley.
It's been a little bit of a theme for us for the week.
It has been, and especially when you're talking about these two banks. So when we're thinking about the biggest banks, these are 5 and 6 on the spectrum, not quite in the big 4 there. But the theme here is really that trading revenue, and we've talked about it earlier in the week, and we're going to talk about it a little bit more in the show, but I think this isn't a huge concern. Okay, you can lower a quarterly estimate, but if you're investing in Morgan Stanley and Goldman Sachs, I don't think you're investing, or you shouldn't be investing on a quarterly basis, because these businesses can be very volatile. But in the end, they're good operators, and they can win in the long run with the trading business.
And this is making the call here is Brad Hintz. He's a very well-known banking analyst, a guy who knows what he's talking about. And he said that it appears that Q3 trading revenue, this is fixed income trading revenue, is turning into a full-scale rout. But that sounds like it's probably true given what we've heard so far. But again, like you said, I think we want to be looking at the long term, and this kind of trading revenue swing is a sort of cyclical short term kind of thing. Third headline we have here, the FT, bankers jostle for pole in league tables. So just a quick explanation, league tables are kind of the ranking system a little bit for investment bankers, and this is kind of classic investment bankers. So the folks doing IPOs, raising money through following offerings, advising on M&A transactions. So the fees earned are one way that they rank in these league tables, and then the deal size is one way that they rank in these deal tables. One of the interesting things that this FT article was saying is that because some of the rankings go by deal size, it doesn't matter what part you play in the deal, it's by the overall deal size. So you've got some of these smaller banks sort of jostling for position to get on fairness opinions, to even do some free work on the deal, to be able to say that they were involved in the deal and get themselves up higher on the league table.
Yeah, it's an interesting point when you talk about league tables. It's really a reputation thing. And the article is talking about how clients look at it a lot more than the bankers. The bankers like to look at it and say, hey, look, we're number one. But it's really the clients. If you're an up-and-coming private company and you're trying to IPO, you're going to go to the league tables to say, okay, who has a good reputation, who has experience doing this? And I think it highlights the economic moat that these big investment banks have. We talk about the investment banking business. After the crisis, there was a lot of talk that said, do we really need these investment banks? What purpose do they have in the economy? They're just speculators. I think this shows you that there really is a spot for investment banks. They have very good expertise in IPOs, in M&A advisory transactions. So when you're these big companies like JP Morgan, Goldman Sachs, that's not something that's very easily to replicate. You and I couldn't go out and start competing with JP Morgan and Goldman.
Could we?
Maybe.
Having been an investment banker in a former life, I can vouch for the fact that the league tables are important in winning business. Investment bankers go into these meetings with pitch books that feature their position in the league tables, and they'll cut up the league tables any which way they can, into just technology banking, into just healthcare banking. Look how we stack up against everybody else. So far in the third quarter, JP Morgan is in the league for total investment banking fees. That's the fees. This is for the third quarter. Bank of America, Morgan Stanley, and Goldman Sachs just following behind. Interesting that Morgan Stanley is in front of Goldman Sachs, but just by a very little bit. On the M&A side, Goldman Sachs is the leader, then with JP Morgan, Morgan Stanley, and Bank of America following there. Here's my prediction. With the third quarter wrapping up on Monday, deals often come together over the weekend. So with the third quarter wrapping up at the beginning of next week, I think we're going to hear some M&A announcements on Monday, perhaps some big M&A announcements on Monday.
We'll see. All right, moving on to our next segment, the rapid fire headlines.
The rapid fire.
First one that I saw today was, I think it was in Forbes. The JCPenney circus goes on as shares plunge. Now this is interesting. We were talking about this yesterday. On Wednesday, Goldman Sachs came out, their research department, and downgraded JCPenney. They said sales aren't going to look quite as good. Shocker. And then yesterday, we saw JCPenney come out and say, hey, we're actually going to have to raise shares to raise some capital. And the sole book runner on that deal was Goldman Sachs. So obviously different parts of the business here. They do have a Chinese wall that separates the two divisions. But if you're JCPenney, you can't be very happy about this. If you're thinking about going through the issuance, and on Wednesday, Goldman Sachs come out and says, hey, this business isn't doing too great. Shares dropped, I think, 14%. And then you have to go raise equity at lower prices.
There's some folks at JCPenney.
Stock is down big again today.
Really angry.
Ugly story there.
Over at the Wall Street Journal, the headline, this is from the opinion section actually, robbery at JP Morgan. This was a fairly political piece, as the editorial section of the Wall Street Journal tends to be, so I usually steer clear of there. But I couldn't help but agree with a lot of the substance of what this was saying, is that it really does seem that JP Morgan has rankled the current administration and some of the people in power on Capitol Hill. And the regulatory furor that's been unleashed against JP Morgan. I mean, frankly, they've done some things wrong. But so is Bank of America, so is Citigroup during the financial crisis and after. And frankly, if you took this much regulatory scrutiny and put it on just about any company, maybe there are some that would escape, but if you put this much on any company, you would come up with some good juicy headlines, guaranteed. So I kind of agree with that there. In other news, this is a separate headline, but JP Morgan, we were talking about the $11 billion settlement. It sounds like the government is pushing to make that a little bit higher, so that kind of goes in tandem with this Wall Street Journal headline.
Absolutely. All right, last headline that I'll be looking at was from Bloomberg. Fannie woos investors as regulators embrace risk sharing. Okay, I'm sure everyone just fell asleep based on that headline with Fannie Mae and regulators and risk sharing.
Shaking it off.
So to simplify this down, if you're out there and you're holding shares of Fannie Mae or Freddie Mac, what these two entities are doing, they're trying to offload some of the risk that they hold on their books by guaranteeing all these mortgages. So they're issuing securities to private investors, to hedge funds, to other institutional investors to try to offload some of that risk. So what this means is, and what you should be watching, is are they successful in doing this? Because the Corker-Warner plan, which tries to get rid of Fannie Mae and Freddie Mac, which would be not good for shareholders in those two companies.
I would assume
as today, if this is successful, that kind of goes with what Corker and Warner are trying to do to bring the private market back into this. So it's not a direct correlation, but it's just something to watch. If they're successful in doing this, and there's a big appetite for it, it may not be good news for those shareholders.
Okay, wrapping up with the Wall Street Journal. Bats prepares to take on big bell ringers. Bats is I was about to say a smaller upstart exchange. It's not so small anymore, and it may not be, I don't think we can really refer to it as small at all anymore. It's getting ready to merge with Direct Edge. And after that merger takes place, it's set to become a larger exchange by trading volume than NASDAQ, and potentially soon overtake the NYSE, which is such a crazy turnaround given that the long and storied history of the NYSE. And even the NASDAQ, by comparison, was founded, I believe, in 1971, whereas the BATS is not even a decade old yet, I don't believe. So we've got this sort of technological upstart, looks like unseating some very established foes.
Right.
Moving to our In Focus for today, and the focus is looking back at what happened this past week. We can rattle off a couple of the big numbers that came to the headlines. Case-Shiller at the beginning of the week was up 12.4%. We've continued to see that housing market recovery. New home sales came in above expectations, and GDP, we saw the third reading on the GDP growth. That stayed steady at 2.5%. So that was, I guess, good news.
Good news, yeah. You mentioned a couple housing numbers there. Story that caught my eye this week as a Zillow shareholder was there was a research report put out.
Zillow's way overvalued.
It was that. So Zillow's down about 7% on the week, so not a great week for the stock. There's a very negative report put out by Citron Research.
Oh, you never want to see that.
So this is a company that basically prides themselves on going after and finding things that maybe look a little shady, maybe look a little overvalued. And there were some things in the report as a shareholder that I had some concerns over. They made some good points, but there were also some things that were concerns that I thought were more opportunities than concerns. So two of those things were they highlighted the increased marketing expense. It's basically shot up over the past year or so, and they're saying this is a concern. Look how much money they're spending to bring in revenue. But in this business that there's not a huge moat, I really think you do have to spend a lot on marketing to get that brand awareness out there, to get people coming to your site. So I didn't see that as a big negative. And the second one was that Zillow has very low market share of the housing internet business. I think it was around 13%. They're saying a lot of it's dominated by local markets. So on one hand, yes, they don't have a huge market share, but I see that as an opportunity, a very fragmented market for them to go in there and take some of that share that's kind of held by mom and pop internet local listings there. The one thing that was concerning was the insider selling. The CEO, some other executives have been offloading shares. You don't love to see that, but it's hard to totally blame them with the stock up over 300% in the year. So obviously you'd want them to see to holding on their shares, never selling a share. That would be ideal, but not totally realistic. So if I'm looking at Zillow today, does it look super attractive from a valuation perspective? No. Is that a little bit of a red flag? No. But I like asking myself questions.
You do. You love asking yourself questions.
So if I was a shareholder and I've seen this big run up, which I have personally, and it's gotten to a point in your portfolio where it's a bigger allocation than what you want it to be, I wouldn't call you crazy for maybe scaling that position back a little bit.
Okay. In terms of also looking back, there was an investment conference overseas. There were a bunch of banks and insurance companies there. There's a Bank of America Merrill Lynch. I can't even say it. Conference. Yeah, it is Friday, and it's pizza day. I've got pizza on the brain. Deutsche Bank was one of the attendees at the conference, and of course we heard some headlines earlier this week about Deutsche Bank talking about fixed income trading falling. Here's the interesting thing. I was looking at Deutsche Bank's presentation from the conference. They did indeed say that sales and trading revenue was down. However, they also said that debt and equity origination volumes were up, and equity trading was up. Interesting that we didn't hear that as the blaring headline. Granted, fixed income trading has been a bigger part of a lot of the investment banks, investment banking operation, but there was some good news in there as well. Deutsche Bank is also really concerned about the tightening regulatory environment. That may be a little bit more of a concern in Europe, but I think that's really a global thing and something that a lot of banks are concerned about. And finally, I've got a little clip here from Deutsche Bank's presentation, and they were kind of looking at the what's going on around the world, the economic picture. And you can see it's a very simple system. The up arrow is good, down arrow is bad, and the sideways arrow is neutral. We can kind of see that in a lot of regions, it's kind of expected. Europe went from not so good to kind of okay. But look there at the US. In June 2012, looking pretty good. September 2013, looking pretty good. So I found that interesting because being in the US and being in the mix, we're so caught up with, oh, this is a terrible recovery, it's not moving along very well. But here's some outside perspective here on the situation. And it's kind of interesting. I wonder how many other regions in the world are going through tough economic times and looking at the US and saying, oh man, how lucky are they that their economy is looking so much stronger than ours. Another presentation that I took a quick look at was the presentation from Santander. The title of the presentation was Clawing Back ROE, which kind of gives a picture of where the global banking marketplace is. I'm glad. One of the reasons I'm glad I looked at this presentation is I knew that Santander, it's kind of gotten a pall because it's a European-based bank, but I've always known that it had a lot of exposure outside of there. Now, in terms of its exposure, this is first half of 2013 profit. 8% of that profit came from Spain, 13% from the UK, 5% from Germany, 25% came from Brazil, 12% came from Mexico, and 6% came from Chile. So that really gives a big illustration of just how weighted Santander is to some very healthier, growing emerging markets. In addition, this goes to all of our talk about Citigroup as such a great global play, global banking play. Santander has a network of 14,680 branches, and this is their words, that they are the largest in the international banking sector.
Interesting.
Or that branch network.
So it's basically, it's almost like a Citigroup without the big U.S. exposure.
Basically. Some U.S. exposure in there, but certainly nowhere near where Citi is. So let's move on to our game for today. It is Friday, so we're playing a little investing chicken.
Yes.
The rules, of course, we will present scenarios to each other on a certain stock, and we just cry uncle, become the chicken when we give up. And the stock for today is?
Regions Financial.
You got it.
Small regional, of course.
All right, I'll start off. Let me go first here.
Okay.
And I'm going to say, what if you saw core deposits dropping 5% quarter over quarter for a series of 4 quarters in a row, even as the deposits at peer banks continue to grow?
That would definitely be a concern when we think about Regions' deposit mix. So they have core deposits, the checking accounts, the savings accounts. They also had a lot of CDs on their books from before the crisis that were yielding a lot of money. Those have slowly been running off. So you have seen their total deposits, I think, tick down over the last couple of quarters, but it's been the good kind of stuff coming off. CDs have been rolling off and core deposits have been strengthening. So if we are seeing that trend reverse, it would definitely be a concern. I don't know if I would sell the stock at that point. I would want to see what's the loan portfolio doing, what type of customers are leaving. So it'd be a concern, but not a selling point to me.
All right.
All right, mine, first one over to you was, we've seen the multiple at Regions Financial move up a fair amount this year, 23%, that multiple has jumped up from a right around tangible book value to now almost I guess in the 20s. So 1.2 something times tangible book. If we saw that continue to move up, go to 2 times tangible book value, is that at a point where you look at Regions, you look at the performance and say, this may not make sense anymore?
I'm probably a seller at that point.
You are a seller.
Among the banks out there, Regions is not one where the business and the operations, I think, are the very best. So at 2 times tangible book value, there are other banks I'd probably rather own.
Okay.
So I guess that I'm the chicken already. My number 2 scenario for you, loan growth suddenly spiked, doubling the growth of peer competitors.
That would be concerning.
Which sounds like some people might read that as a good thing, but why would it concern you?
It would be concerning because if everyone else is kind of holding on and not liking the risk environment and their loan growth grows, that could be concerning. So when we look at banks and their loan growth is not growing, we shouldn't take that as an absolute negative, because it's all about what rate are you willing to loan out to your customers, to those clients.
I can start a bank and
Exactly.
go out and lend all I want.
It's easy to grow your loan book. Any bank can grow their loans 20% in the next year if they want to. They just have to offer very, very low rates. So that would be the concern. If they weren't dipping on the rates there and people were just really wanting to get loans from Regions because the client support was that great, then that would be good. But if not, that would be a concern. Maybe not a selling point, but those two combined, I might sell.
Okay.
All right, my last one to you, even though you're already out. We'll forget the first one.
We'll pretend that I'm not a chicken already.
We'll say that the multiple, the price to tangible book stays where it is today, but the combination of new capital rules and fee revenue just don't quite get there. You're never going to see return on equity of 10%. It's always going to be below that.
Ooh. Yeah, I'm selling there too.
Not worth it?
No, particularly looking at the valuation today. So you're looking at, I guess it depends on what shade of under 10% you're talking about. Maybe if it's high 9%, that's potentially, but even there, if it's much lower than that, if you're talking about a 1.3 times tangible book value at 8% return on equity or 7%, that's just not that attractive.
Okay.
So I'm twice over chicken.
Yeah, so I guess the takeaway here is Regions has had a good run the last couple of years, the last year or so. We've seen the multiple expand.
Wait.
Returns come.
Hold on. Before you
do you
wrap
have
it up,
another
I've got one more for you. I know you did. I came prepared. I'm stocked up here. The final one is the stock traded up to a price to tangible book value comparable, the same as PNC Financial and Huntington.
So just the multiple's the same?
Yeah.
Okay. Well, it actually is very similar to those two, I believe,
thought
right now.
That was a bit of a trick question.
You're going to try to trick me there.
Because Regions
similar,
is at
right?
about 1.3 right now, and Huntington's and PNC's is they're both at 1.4.
I think those are all reasonable valuations right now, considering the earnings power going forward. I think PNC has the best earnings power potential.
Well, yeah, we'll see that. I mean, that was kind of my point in bringing this up, is that we've now got Regions at 1.3 and PNC and Huntington both at 1.4. Now, I am a Regions shareholder, but now I'm looking at this, and I do own PNC as well, but I don't own Huntington. So I'm looking at the mix here, and I'm like, I might rather own Huntington, even at just, I mean, it's just a slightly higher valuation, but at that valuation, I think it's a better operation.
Right. When multiples start to look similar across the board, that's when, as an investor, you really have to go in and say, okay, what's the earnings potential for this bank, in addition to what's their management saying about the risk environments. With those two together, with multiples being equal, you really have to go to the earnings power.
So once I stack all of these together, I've got you selling, right?
Yes.
All right. So at least I'm not the only
we
chicken
can agree that Regions looked attractive. It still looks relatively attractive today, but going forward, it's not going to be as easy of a slam dunk. They're really going to have to start performing.
So it's for me, it's more just that I think they're better banks to own.
Right.
All right. Finishing off as we always do in the Twitter sphere, David, kick us off.
First tweet is about Bank of America, one of the biggest banks out there. So it's from Dion Roberts at Dion E. Roberts. Bank of America stock downgraded by analysts at Guggenheim Securities. Matt, we talk a lot about.
I'm selling.
We talk about Bank of America a
That's
lot.
it.
We talk about their business a lot. We talk about Brian Moynihan, the lawsuits. Sometimes we skip over kind of what does the stock look like today. Do you still think the stock? You're a shareholder. Do you still think it's attractive stock today, or I should note that the report downgraded it from a buy to neutral. Do you kind of sit in that camp?
I'm selling right now. I've already sold. I just took out, while you were talking, I took out my mobile device, my mobile E-Trade app, and I sold.
Sold it all.
No, look, you keep saying stock, and I know you mean stock, and maybe you mean company a little bit too. But the reason that I'm still hanging on to Bank of America shares today is because of the company. Because what I'm expecting to happen, and I think the real story here, is that there is a lot of cost that's going to come out of Bank of America as it unloads a lot of the litigation stuff, a lot of the extra employees for handling the overwhelming number of foreclosures and all that kind of
branches. We saw yesterday that they were closing the most branches by far of any bank out there.
So as those costs come out, Bank of America is going to become much more profitable. And I really don't think the market is looking ahead quite to that. It's looking ahead to better times, but I don't think it quite sees that yet. And when that gets here, I think we're going to see some big movement, some nice movement in Bank of America shares.
Great.
The second tweet we have comes from our own Morgan Housel. That's at TMF Housel. He says, headline, volatility will last for decades. Morgan says, also, summer to occur around mid-year for the foreseeable future. So apparently Morgan not only an economic analyst, but a weather analyst as well.
So yeah, he's pointing out that volatility is always going to be there. And obviously we're going to talk about how this relates to banks, and not from the volatility perspective, but from things like loan loss reserves and releasing those. We've seen a lot of talk about that. Last quarter, a big chunk of Wells Fargo's earnings were releasing reserves, and people were saying, oh, this isn't really fair. That's not real revenue. That's always going to be the case. There's going to be reserves, there's going to be provisions. That's just the ebb and flow of banking. So you can't look at this and saying, well, for the upcoming future, it's only going to be releasing reserves. That's the only good news. It's going to be a cycle, and there's going to be back and forth. It's always going to be that way.
This reminds me a little bit of when people say there's a lot of uncertainty in the market right now. And it's, when is there not a lot of uncertainty right now? We're thinking about the future. The future is always uncertain.
No one wakes up and says, God, I just feel really certain about this market for the next year. All right, moving on to the last tweet is from our own Jordan Wathen at JWTHN. I love how the word taper has found itself in more common non-financial language. Cool how words travel / rise and fall in popularity. Matt, what are you tapering that is not financial?
What am I?
Other than your running, because I know you taper off running.
Well, I'm way tapered off now. I just had a race last weekend. For whatever reason, reading that tweet made me think of tapeworm, which I feel like right now because I'm so hungry. It's pizza day, as we've said a couple times, and I'm so ready for some pizza. I feel like maybe I have a tapeworm.
I'm not even gonna respond. We're gonna wrap it up there so we can get down. Let's do it.
All right, folks. Sorry to end on the tapeworm note, but that concludes it for this week. We will be back next week with some more Investing Chicken, some more Rank It, all of your favorite games, all of the stock analysis that you've come to love from, I guess, mostly David. Thanks for watching, folks. We'll see you next week.